You've seen them on TikTok. Lisa from Blackpink is holding them. People are camping out overnight in Los Angeles just to get one. I'm talking about Pop Mart, the Chinese toy giant that turned blind boxes into a global addiction. The stock has been on an absolute tear. But here's the uncomfortable truth. While everyone is chasing the hype, the math tells a different story. I'm Lynn, and today we're doing a deep dive, a sum of the parts valuation on Pop Mart. My analysis suggests this stock is trading nearly 32% above its fair value. Is Pop Mart the next Disney, or is it a bubble waiting to pop? Let's crunch the numbers. For my American friends who might just be seeing these pop up in malls, Pop Mart isn't just a toy company. Think of it as Funko Pop meets the scarcity of Supreme with the gambling mechanics of a loot box. They own massive intellectual property like Molly, Labubu, and Demu. They sell them in blind boxes. You don't know what you're getting until you open it. It's genius, high margin, and highly addictive. Financially, they are crushing it. Revenue is exploding, and they are expanding aggressively into the US and Europe. But as investors, we have to ask, is this growth already priced in? To find out, we can't just look at the PE ratio. We need to break the company apart. We're using a method called SOTP, sum of the parts. Imagine Pop Mart isn't one business, but 4 different businesses glued together. Let's value each one separately. First, the core engine, collectibles. This is the bread and butter, the toys, the blind boxes. We used a 5-year discounted cash flow model here. Even giving them credit for aggressive international growth, we value this core segment at about 113 billion HKD. This is the cash cow. Second, digital and tech. This is where it gets tricky. This includes their apps, online games, and digital ecosystem. The market treats this like a Silicon Valley silicon tech startup. We're assigning it a generous 40 billion HKD valuation, assuming high margins. But honestly, this part is still unproven. It's priced for perfection. Finally, you have their experiences and investments. This covers their theme parks and their investment portfolio. We value these at roughly 5.5 billion HKD combined. Nice to have, but they don't move the needle much. Here is the problem. When we add all those parts up, the toys, the tech, the parks, and the cash, we get a fair value target of 128 HKD per share. But the market? As of mid-December 2025, the market is paying 189 HKD. That is a 32% downside risk. The market is pricing Pop Mart as if nothing will ever go wrong. They're assuming every American will buy a Labubu, every digital game will be a hit, and no regulators will touch the blind box gambling mechanic. That is a dangerous game to play. Why am I cautious? 3 reasons. 1, valuation disconnect. You're paying a premium for growth that hasn't happened yet. 2, execution risk. Expanding into the West is hard, rent is high, and labor is expensive. 3, the fad factor. Remember Beanie Babies? IP fatigue is real. If Gen Z gets bored of Labubu, that stock chart will look very ugly very fast. Look, I actually love Pop Mart as a business. They're the Disney of China in the making. But a great company can be a terrible investment if you overpay. My rating? Underperform. If you own it, consider taking some profits off the table. If you're looking to buy, don't FOMO. Patience pays. I'm waiting for a pullback to 110 to 130 HKD range. That's where the margin of safety is. Until then, I'll stick to buying the toys, not the stock. What do you think? Is Pop Mart the future of toys or a passing trend? Let me know in the comments below. And if you want more honest valuation breakdowns like this, hit that like button and subscribe. I'm Lynn. See you in the next one.